COVID-19, how is it affecting mortgages and interest rates? Jeff, what are you seeing?
First and foremost, Eric, I appreciate you taking the time to have me on today. So far, what we've seen from this is unprecedented volatility. That's probably the best way to sum up what this has brought about. It's shaken up a lot of industries. Ours is no different. Rates are higher than they were, I'd say, a month or 6 weeks ago. We're seeing a lot of intraday trading in the mortgage-backed security market. A lot of reprices throughout the day. Whatever we get in the morning doesn't necessarily hold true, 1, 2, even 3 hours later throughout the day. We may see different rates at various points throughout the day. A lot of this is just a result of prior to COVID really coming into effect. Rates were really low. We were around 2.5 on a 15-year rate, or 3.25 roughly on a 30-year. And there was essentially an overabundance of supply. And when we have that in the secondary market, when you have this type of volatility going on around the world, these investors at this point are moving to cash. And when you have investors moving to cash, it throws all types of volatility in the secondary market, which in turn equates to higher interest rates. So, outside of the volatility through all this, we have definitely seen rates climb over the last few weeks. And we're hopeful that they return to lows, but at the meantime now, they're still competitive, but higher than they were prior to COVID-19 going into full effect here.
Okay. When we say that they're higher, though, what are we talking about? Obviously, you can't commit to it because everything's changing all the time, but we're still under 4%, correct?
Correct. So your prime candidate, a decent loan to value ratio, meaning they have some equity in the property, prime credit scores, 740 plus, low debt to income ratio, where everything else makes sense. Your prime candidates I'm speaking to here, you're still probably getting a rate around 3.5, 3.625, 3.75 again, depending on the day. The big difference is the margins or the spreads in these rates. And again, that's all determined on secondary market, which coupons are selling for what, the 3.5, the 3.625, 3.75. The margins may differ. So we're at a point now where we're charging more borrowers, 1/4 point, 1/2 point, full point with the rate. But par pricing, we're still somewhere in line around that mid-3s point.
Okay. So long story short, what I'm hearing is it's crazy. Interest rates are still, at least from a historic perspective, fantastic. If you're running with something crazy, like I was talking to somebody 2 days ago and they said, yeah, we've got a 6.25. Well, that's insane. They absolutely should be refinancing. So people still can and should be refinancing. And, next week, who knows? The interest rate goes down. Next week, the interest rate goes up. Nobody has any idea because of this volatility that you're referring to.
Correct.
Because if I remember correctly, there was like a week and a half ago. Didn't they drop to some historic lows?
They did. I'd say this was about 4 weeks to 6 weeks ago. Correct. I was locking individuals at 30-year fixed rates at 3.25%.
Okay.
15-year term, 2.5. And then we're definitely not there right now. But like you're alluding to, what I'm recommending to all my clients right now is if anything high 4s, it still makes sense right now to do something. If you're low 4s or mid, well, my recommendation is we're getting applications in place with these clients so that when the opportunity does strike, I'm able to just place a quick phone call and then lock, rather than waiting too long to the point where I have to call you, get you on the phone, get the entire application in place. Because, on any given day, we may have these opportunities for a few hours on one particular day or 2 particular days. There's no guarantee that if we hit bottom again, it's going to be there for a while. So if I'm scrambling to get somebody on the phone and it's a day where they're back to work or whatever else is going on right now and they can't take an application, we may miss out on that opportunity to get that super low interest rate.
Gotcha. So if I'm on the fence about refinancing, now's the time to get all my paperwork in with you, because if we do have a low day, you can lock me in.
We can capitalize on the opportunity
over the phone. Right? Yeah, and then I can save a couple $100. That's kind of how I think of refis. I don't like volatility in the market. I don't think that's good for us as a whole. But on the days where it is crazy like this, I got to be honest. I love making the phone call and being like, "Hey guys, now's your chance. You can go save $100, $200, $300 a month
for
the rest of your loan." I feel like I'm just like doling out coupons. Like, here's your Bed Bath & Beyond coupon for the next 30 years or whatever it is.
It's all about positioning right now. It's everyone right now, whether they're being sent home because their jobs are not life sustaining or life essential, or even if you are at work, In these down times, there's always great financial opportunity. Anyone who's sitting on cash right now is probably trying, at least at the point where they're considering getting that money, if they haven't already, getting that money into the stock market. It's a great buy opportunity. And refinancing is nothing different than that. We're trying to capitalize on an opportunity that's being presented to us from a financial downturn. So if you can put yourself in the best position possible to take advantage of that, then we can try to find some positives in all the negativity that surrounds us right now.
What about people that are thinking of selling in the next year or two? So what I generally advise is I say refinance if you're staying there. But I have a couple, they're looking to sell probably later this summer, and they said interest rates are low. Should we be refinancing? My thought is no. What is your take on that?
Correct. My thought is, my first question when I'm looking at anyone refinancing is always, how long do you intend on being in the house? Because there are certain costs associated with refinancing, but there are also how do I say this, ways with refinancing that we there are costs, but there are ways to reduce the cost as well. So when we refi, you're typically able to skip 2 payments, because whatever month we fund you in, you don't have to make your payment that month because we're satisfying loan in full. You always skip the following month. So when you factor in the 2 skipped payments plus the return of your escrow account from the loan that's been paid off, it's typically a minimal add to the actual loan amount. There still is an add though. So when we look at the difference in your monthly payment versus the amount we have actually added into the principal balance, what's our break even point? So when we can determine how many months we're going to break even, if we're going to be in the house longer than that, it may make sense. If we know we're going to be in the house less time than our break even point, definitely doesn't make sense.
Gotcha. Okay. But you help us with that math, so I don't have to
Yeah.
guess anymore, right?
Yep, correct.
Good. I don't like guessing, and I like people who do math for me. Those are two very good combinations. All right. So, summary: great time to refi. Still a good time to buy, though, if I need a house.
I mean, I still think so personally. Yeah, if listen, if you missed out on the 3.25, it is what it is. But if we can still capitalize on an interest rate where we're talking mid or high threes, you're still borrowing a lump sum of money at a very low interest rate. And what I always try to relay to my clients is the fact that even if the rate's a little bit higher than where it was, we're still in a great position. And at the end of the day, whatever money we have sitting on the sidelines, I always advise borrow as much as you can, because if we can borrow this lump sum of money at 3.625 or 3.75, and we can hedge that at that rate, we should be able to outperform that money in other investment vehicles, whether it be retirement, IRA, 401ks, investing in mutual funds, stock markets, ETFs, whatever the case is. It's still a great time to capitalize on an opportunity to borrow money at a very cheap rate.
Yeah, I couldn't agree more. I remember my wife and I had the same conversation when we bought our house. We kept the money in the bank. We needed the nest egg for the kids or if a car failed. And frankly, our financial advisor was outperforming the interest rate that, we were being charged on the mortgage. If I get 3.5%, that's nothing. I do that all day long and
Yeah,
all my, all my
most
investments.
would.
Yeah,
Most would.
exactly.
Yeah.
So good. No, I thank you very much. I appreciate it. If there's any final thoughts you want to toss out there, but thank you so much for the update on the mortgages.
No, I just think everybody right now should remain optimistic. I really do. I think this is more I'm reading data, the more I think this is a short-term cash flow issue for certain individuals. But long-term, I think we rebound pretty quickly economically once this is all said and done. So everybody just try to remain positive, and we'll get through this thing.
That's my hope. And I know I've been sharing with a lot of other individuals. It seems to be the same way with the real estate market because it's such a saturated buyer's market. We've had way too many buyers, not enough sellers. I'm expecting home values to remain fairly stable as long as we get through this in the next couple of months, just because even if we lost half the buyers, we still wouldn't be able to, we'd still have too many buyers for the number of sellers out there. So
Yep.
easy time to sell and no harm, no foul if we lose a few buyers on the side, frankly.
Correct. Yeah.
So markets are stable from real estate perspective. All right. Thank you so much. If you guys have any other questions for Jeff, feel free to reach out to him directly or message me. I appreciate it very much, Jeff. I'll talk to you soon.
Thanks, Eric.